Jens, welcome. And as usual, it's a pleasure to have you on this webinar.
Hello, Theo. Nice to be here. How are you?
I'm very well, thank you.
You're looking awesome.
Oh, thank you so much. Too much trading this week. Also on the live webinars, we've done a lot of trading because
that was
the
interesting,
markets, they
no?
offer
So
some.
I was surprised myself. So last week we had the big earnings. No, the week before already.
Yeah,
last week was April.
yeah.
And then I was like, well, probably it's calming down a little, and it's the complete opposite. That's pretty great, to be honest.
Yes, exactly. Exciting for the webinar today, right?
Oh yeah, because
Yes.
we have lots of stuff to cover, because we had the FED and the ECB rate decisions. That was already last week, but still there's the question how to trade the new infos, respectively. What did we get to see, and what we will make out of this in the upcoming weeks, probably till the next event, especially around the FED, I think.
Yeah. Awesome. Awesome.
Shall I share my screen?
Just give me a sec. Yes, you can try now.
So everyone
Perfect.
can see my screen?
Okay, from me, best luck, and of course, happy weekend to you and to everyone.
Yes. Have a nice one, and talk to you next week. I look forward to it.
Absolutely. Thank you.
So hello, and yeah, welcome from Berlin, from Germany, Berlin, and sunny weather over here. Again, weekend is ahead of us, but still we have plenty of things to cover, especially when it comes to the ECB and the Fed rate decisions. We wanna get an idea on what they delivered, and also how to put this into perspective, especially probably around the Fed and around the inflation numbers, which came out on Wednesday. But we also want to have a look at the developments around the ECB and their rate decision. It's interesting to see, in fact, that they are quite clear in their communication, saying, well, we are not yet done. They let's call it decelerated a little. They gave us the rate hike of 25 basis points, but they will likely continue with hiking rates. This is surprising, especially once we see the developments in the US, especially with the rate hikes, where the banking sector, especially around regional banks and developments around First Republic. Today, again, I think it's PacWest, if I'm not mistaken, which is in the news and selling off sharply too. We had Silicon Valley Bank already in March. So several of developments here with signs of stress in the banking sector. As of now, there is not yet stress to be seen in the European banking sector, but I think it should be clear that tensions here behind the scenes are also seen, and it's very likely that there will rather sooner or later also follow banks. I mean, we already had Credit Suisse and the developments there, but I think that's only the tip of the iceberg. I think there's more to banks over here in the European banking sector. And that being said, chances increase, in my opinion, that the ECB has not that much room to go any further in terms of their restrictiveness, which is something you can see when looking, for example, at EURUSD, when interpreting the price action based on this fundamental outlook, and something we will cover here in the upcoming minutes. Very important note, and here's the risk disclaimer. So it could be, it's not just that I put everything in perspective here around the ECB and the Fed, and what to make out of this from an opinion standpoint, but also it could be that we are formulating trading setups. And that being said, please be aware that everything I present to you here is for educational purposes only. That means it could be that we are formulating a trade game plan hypothesis for the upcoming days based on the current price action. But if you trade this, then please make sure that you understand we are covering leverage products here, and they involve risks. Leverage products especially contracts for difference, may not be suitable for all investors. So before you start trading live, first of all, download a demo on at admiralmarkets.com. Get a feel for trading these products, and then if you decide to take a trade, probably you are already beyond that stage, and you say, well, Jens is a nice guy, and that makes sense what he tells us, and the thesis, I like it, and the setup, I like it. Please make sure that you understand that you take all risks and responsibility when taking these trades. So I cannot guarantee that what I picture here is right, that you will make money based on these ideas. There's always the risk of losing money, and that's something you should be aware of. Please read the risk disclaimer carefully. Check out the website admiralmarkets.com for the risk disclaimer here in full. Read it, and please make sure that you understand the risks involved. I don't think that I need to introduce admirals here any further, because Theo did already a very, very good job. It's one world, it's one broker, but our topic is in fact, what can we find in the charts, respectively, what can we find here? What can we find? What can we find in terms of the Fed rate decisions? First of all, let me probably here make sure that we know which chart we are looking at here. We'll dig deeper into this in a few minutes. So it's only that you know that it's KRE. What is KRE? KRE is an ETF which covers regional banks. So you find, for example, First Republic in there. It's a 4-hour chart here, and you can clearly spot there was a big drop. So clear topish pattern which occurred over the course of the year 2022, especially topping out here at the end of early 22, so it's January around. And so then we are breaking down here. That was in March, and haven't yet found a bottom. So there were signs of probably some stabilization around 41, and then we dropped that level too and sold off again on the downside, dropping another 15-20% or something. And as of now, it wasn't that it was a sharp push lower or flush lower and then we saw a bounce, but it's like we stay heavy on and it seems as if selling is not yet done. Question is, what happened here? So the initial breakdown below the 2022 lows, that was around Signature, respectively Silicon Valley Bank. You've probably heard about the news back then, that they had trouble in terms of their bond portfolio, especially bought massive amounts of bonds, longer dated bonds. And since the Fed started hiking rates, these showed losses, so floating losses. And you're not there's no obligation to show these losses, in fact, because these are just floating losses. They are not yet realized. But market participants, or let's say clients, they used lots of billions and billions, not trillions, but billions of dollars, and I poured it into regional banks after COVID and after the pandemic in 2022. And here with this run higher, there was a large capital inflow. And now people demand their money back, or demand money because they have higher outflows is probably the wrong word. What's the right word? Expenses is the word I was looking for. So in terms of rising inflation here, and in this regard, they need money. They probably need money to keep their businesses afloat, probably due to rising energy costs, for example. What else? So I think that's probably fair enough. And that being said, then means that a bank, in this case Silicon Valley Bank, but it's also true for other banks like Signature. It's also true for First Republic, because they all played the same game, buying longer dated T-notes here, and they can keep them, and they don't need to report floating losses, since again, they are not realized losses. But if yields rise, these prices of the bonds drop, and thus you have then you hand out longer term the money, to, in this case, like the US government, for example. And shorter term, there's a liquidity crunch occurring due to the fact that people demand their money back. And now you have to realize the losses. And if the losses start to increase to a level which is greater than the available capital, then you have trouble as a bank. You're in fact insolvent, and then you need help. You need someone to bail you out, or you need a clear sign. In this case, it's not just that you need the bailout, but also a clearer sign in terms of relaxing the pressure you face due to rising yields. You need a clearer sign from the central bank, in this case the FED, that they won't continue hiking rates. So long thing short, it was that was just the tip of the iceberg with Silicon Valley Bank and Signature Bank, and now it becomes clear that there's also other banks involved, which was clear, to be honest. We've seen trouble occurring in terms of First Republic was sold for, I think, $1, I'm not sure, I think the $1 story, that was the British part, I think, of Signature or of Silicon Valley Bank. I don't know, who cares? Like, okay, well, at the end of the day, the small banks were sold to the big players like JP Morgan. There's other banks having trouble right now, PacWest, for example. So all things put together, well, if you have an ETF here covering these banking stocks, well, you see a sell-off in this case. So these stocks sold off heavily, and it doesn't seem as if the pressure is going away, let's say. Probably that's a good way to put it. So that's the situation in the banking sector. So now let's head over here to expectations around market participants. Probably look at what we got to see last week, or trading wise. I'd stay away from banking stocks in the US especially. So regional banking stocks, like you might say, well, they get bailed out, or they get I don't know, they get liquidity, whatever you conclusion you might come to. You might say, well, they don't let the banking sector continue to bleed. Well, I wouldn't buy this here in this current area. I think it's still, we are far away. And to brighten the picture, let's say, to be willing to trade from the long side, I'd say, well, we minimum have to come back above 42. Probably from a pure market or Dow theory perspective, I'd probably say the last relative high here, which can be found around 44, 45 around. I want to see this being recaptured, and we hold above that I consider the bottom being in. Here, this is just, it doesn't look very promising, and it stays heavy. And as long as we are not breaking this sequence, and in this case on a 4-hour chart, I don't want to be long regional banking stocks and bet on a bounce. Similar probably to one we've seen here in July, where we headed within 1 month from around 56 back then up to 68, which is quite a bounce. I mean, that's over 20% in less than 4 weeks. Here in this case, that still doesn't look very promising and very heavy. So I probably stay away from that. So now, but let's come to the FED and the FED Watch tool. So what did we get to see last week on Wednesday? Last week on Wednesday, the FED decided to hike rates by another 25 basis points. That's no big surprise. We could have seen that coming. It was priced in nearly 100%. And so the current target rate, you can find this here, by the way. This is the FED Watch tool. You're probably already aware of that and know where to find this, because we've mentioned that several times. Let me just share here the link, FED Watch tool. So there we go. So what do we have here? Well, we have the current target rate, or it's to interpret this. These columns show, based on the futures market, they show what do market participants expect the rates level to be at the next FED meeting. So what will the FED do? You can see here several tabs at the top, and there we have, for example, the June meeting. We're not having the May meeting anymore, because that happened already last week. But the picture was very similar to this one here, with a big difference that there was now a battle, let's say, between will we get to see the 25 basis points rate 25 basis point rate hike, or will the Fed already pause? That's very important to note, because this is exactly what we got to see in terms of their communication in their statement. But now what we have here is that with the likelihood of over 90%, and this is what this column shows, that at June, or at the 14th of June, at the June meeting, there won't be any rate hikes any further. But this is not what's the big deal. The big thing is that if we go 6 months into the future and look here, what does the market participants or the future market expect the rate level to be in December? You click on this. Well, you see that here we have a likelihood of over 70%. These two columns on the left of 425 to 450 basis points, which is obviously 75 basis points lower than where we stand right now. And this is very interesting. By the way, let me just, I just realized that I forgot to open one here, one tab. That's a CNBC article from last week on Wednesday. As you can see in the headline already, you have it here. Fed increases rates at a quarter point and signals a potential end. This is very interesting because a potential end means, well, we're not really sure. Will there be a pause now, or will they continue hiking rates? So as you can see here, when looking at the June meeting, there's around 10% of market participants here, or it's not the market participants, we have a poll running here or something like that, because what this tool does is it extracts, based on the pricing and options especially, it extracts what's the market currently paying for options into the future at these dates here for example, hedging against risks of yields rising, respectively rate hikes in this case. So this is where these columns come from. And so what you can see here, let me just check it out. It's coming to an end. The post-meeting statement here, the post-meeting statement, that's what's of interest here. Post-meeting statement omitted a sentence present in the central bank's March comments saying that the committee anticipates that some additional policy firming may be appropriate for the Fed to achieve its 2% inflation target. And there's something else. Let me just check it out here. Growing banking crisis, post-meeting statement. Statement also tweaked language. Here, the statement also tweaked language to outline the conditions under which additional policy firming may be appropriate. Previously, the FOMC had framed the forward guidance around how it would determine the extent of future increases in the target rate. The statement reiterated that the Fed will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation and economic financial developments. Taken together, moves are at least a tremendous nod that while tight policy would remain in effect, the path ahead is less clear for actual rate hikes as policymakers assess incoming data and financial conditions. So that's how this is interpreted. And so now coming back here to the Fed statement, very interesting. They never said anything in terms of like, we will cut rates in the second half of the year because the conditions in the banking sector worsen, or the economic outlook is very, very unclear, or there's a recession at the horizon, something like that. There was nothing said like this. And now we're heading 6 months into the future. And what do we see? Well, we see that the market is pricing in rates which are 75 basis points lower than what the Fed projected. How do we know that the Fed projects this? Well, it's not just the statement itself, which I lined out here from last week, but in addition to that, there's another way to look at it. It's called the economic projections. It's something they release each quarter, March, June, September, so June next month, June, September, December. And within these economic projections, what you have, if you scroll lower here, you can see that on the 4th or 5th page, you have a very pathological looking graphic here. It's the so-called Fed dot plot. And what does the dot plot show us? Well, each dot represents one FOMC member, a voting member here within the FOMC. And that's very interesting because now you can see here, there's a timeline, 23, 24, 25, and here you have rates, or the target rate. And what you can see is that these dots here are obviously, the majority of these dots is significantly above what the Fed, or what the market, the futures market is pricing in here. Why do I say that? Well, December, so this is the last meeting in 2023, and at this last meeting, we know where the target rate will be. Futures market says 425 to 450. That's where we see the target rate at the end of the year, with the likelihood here, I mean, it's not 100%, but it's closer to 100% than to what the Fed sees it. It's over 70%. Plus, have a look here, 500 to 525 is 0.1%. So it's 99.9% that there will be at least one rate cut of 25 basis points till December. Looking here and then combining it with the statement we just got, and combining it with the last economic projections from March, 2 months ago, so 2 meetings ago, if you want, well, we can see that the FOMC is clear in its communication saying, well, there will be no rate cuts. And this is a huge divergence, in fact. So divergence in terms of the market saying they have to cut rates, and the FOMC says, well, we're not seeing any signs of rate cuts or necessary rate cuts right now. It's not that these guys at the Fed are probably, well, not really knowing what they're doing, let's say. So that's probably a very harsh way to say it, but let's face it, and let's be honest. I mean, the last 30 years around Corona and the pandemic and everything like this, and what signs, I mean, it should have opened our eyes, let's say. And in addition to that, everything we've seen in terms of like this massive run higher in inflation, for example. So these are probably, or at least that's what they tell us, these are the best economists here around, sitting at the Fed, deciding on the monetary policy path of the world reserve currency, and they didn't see inflation coming the way it finally hit us, which was in fact visible for someone who probably finished the first semester in university when it comes to economics, because if you cut the supply of goods by locking down while increasing the money supply, handing out stimulus checks to people, and there's more money chasing fewer goods, well, then surprise, surprise, prices will rise, and you have rising inflation. And they reacted to the rising inflation after it was already too late. We've seen that coming already over the course of the year 2021, and then they started aggressively hiking rates. And that's something we can spot here. So we come back to this here. This is inflation. So inflation picked up significantly following the COVID crash. You can see it here. So it wasn't the, let's call it Putinflation, so the invasion of the Ukraine from Russia, for example, and the sanctions kicking in, but it was already visible earlier. You can see it here. So the middle is around 2021, and then there was this huge rise higher. The invasion here of the Ukraine by Russia, it happened early 2022. So that was the last push higher, but we've already seen a massive increase in inflation over the course of the whole year. But coming now, so we see this significant push higher here and push above the target rate of 2%. That was early 2021. And rate hikes in the US, this is something you can also spot here when looking at the trading economics and then the US. Rate hikes started from 0 in April 2022, when inflation already jumped above 2%. And when inflation completely went into full rage mode, let's say, and I'm peaking at 9%, that was around in June, July last year, the Fed was with its target rate below 2%. And while inflation already peaked up to 9% already, and they continue to hike and hike and hike and hike and hike. And finally, now with hiking to 500 to 525 basis points, and inflation here coming down to now 4.9% year on year from Monday, well, we are now above inflation and have a better chance. Let's say, I'm not really sure whether it will, it's already a good chance, but we have a significant better chance now to bring inflation back under control and pushing it back into the range around the target rate. But why do I mention that? Well, that was something you could have seen coming, which means if I had to take a side now, I'd go with the market and the market participants here, even though it's important to note that we need to be sure that we understand, even if there's this divergence right now, and the market is pricing in with the likelihood of over 70% rate cuts by 75 basis points in the second half year of 2023, it's not as sad, or it's not clear whether this is only directional bets, so people saying we expect the Fed to cut rates, or probably there might be some market participants betting on that, but it also includes market participants hedging their exposure. So saying, well, guys, you know what, we're not really sure where to place our bets here and how to position ourselves, but we are aware there's probably a risk of the Fed cutting rates due to new tensions, let's say in the banking sector, or a massive drop in employment situation, or whatever it might be. We might be caught wrong on our side, on our trade we have right now when looking at institutions. So what I have here is now a bar chart, and there we're going to the commitment of traders report, also something which is noteworthy. So looking here at the S&P 500, what we have here in the S&P 500 is the commitment of traders report. It covers the positioning of the large speculators, also the so-called commercials, like institutions hedging their exposure in, let's say, I don't know, sugar, for example, if you take Coca-Cola as an example, or currency risks, if you have a big company which is doing business worldwide, for example. However you put this, you have also certainly the possibility here to take speculative bets on the S&P 500. And what you can see here is that we are very close. Probably we get to see a break higher today. That's something to keep an eye on. I'm very optimistic right now, to be honest, because I somehow, there's a feeling telling me we are about to break higher, probably today already, because today we have no big news events. So I've seen the break higher already triggered, for example, by inflation data, respectively by the Fed last week, probably after an initial flush after the rate hike came, and then we made back these losses and ran into the last weekly close. But to be honest, I see the break higher here. And now let's assume, and what you can see here is the green line. This green line tells you nothing more than the current positioning, the net short position in this case. So if there's a minus, it's a net short position of big speculators who are, so big in their positioning in the S&P 500, CTAs, hedge funds, portfolio managers, whatever. You can see it here, managed money. People who are really betting aggressively that the S&P will drop, well, and it's not that far that we'll make new yearly highs, and they could be caught off guard, meaning they have to cover their or hedge their exposure, which means there's chance of a squeeze occurring, especially if we get to see a weekly high or a weekly close above that level. First target then could be found, I think, in a region around the August highs, around 4,300, 320, 330, something like that. But if you're caught off guard here, well, you want to at least hedge some of this exposure. And such a push higher could be triggered by a more dovish stance from the Fed in this case, which means, well, then these hedges are already found also within here, and something to keep an eye on. But all in all, big divergence. That's what we should take away from this. And then so the market right now, market participants, futures market, is not believing what the Fed is telling them. And that's something, that is something which is also very interesting when it now comes after the Fed. So all in all, we have to say, well, it was quite hawkish, but still, it somehow leaves I don't know, strange feeling. Let's put it probably that way. Strange feeling is probably a good way to put it. So it's like, well, the Fed is mistrust here. So the market participants are not buying what the Fed is selling them in terms of keeping this restrictive monetary policy path, probably especially since they are looking here at KRE, for example. So this is the ETF. We could also have a look now at FRC or I don't even know whether the stock's still tradable, but PacWest in this case. You can clearly see here there's a massive pressure in the financial sector, and that means, well, obviously, rather sooner or later, the Fed has to take a looser stance when it comes to monetary policy. The same is also true when it comes to the overall economic developments, even though this looks quite stable. When looking at the employment situation, we covered the non-farm payrolls last week on Friday, but also in addition to, for example, let me just also check out here for you another great website. It's the Fed. Let me just, no, it's not FED, it's Atlanta. It's the Atlanta FED GDP tracker. So what these guys do, so there's several FEDs, let's say, in the US, and the Atlanta FED is one of them. And they take the economic projections and then they project into the future based on retail sales and so on and so forth. They project based on that where the next GDP growth numbers will come in. And what we're currently facing here is that we're at, this is from 8th of May, so 4 days ago, it's 2.7% for the second quarter, their projection. So that looks still, it's not very recession-like what we get to see here. Same is true for the employment situation. And having that in mind, well, this is probably giving the Fed some room to keep a more restrictive monetary policy stance. But if we get to see a drop here and the economic output starts to decrease, then I think there's another sign which will put a lot of pressure on the Fed to lower interest rates again. And that's something I take out of this. What does it mean for the market when looking, for example, at gold? Well, all in all, I'd say this is a bullish environment, and you want to be gold long, even though the latest developments here are not very promising, let's say. So what do we get? So this is now a 50-minute chart. Let me just scroll over here. So that were the non-farm payrolls. We've seen the follow through, but we didn't drop below 2,000 last week. That was interesting. We've seen here, that was the Fed spike higher, and we continue to trade higher up to the all-time highs, by the way. Overnight, we pushed towards 2,080. And then we dropped sharply back here. That was on Friday, but we held quite steadily. Now you can see here, that was the inflation release. That was yesterday. So there's some very whippy, some very choppy action right now taking place. But one thing seems clear: we are not dropping 2,000 anymore. So we are holding above 2,000, which is a psychological level. And I think once we're breaking back above 2,050, 2,060, we are off the races. And that's also something I'd like to mention here. I haven't prepared a chart right now, but after we've seen the Fed cutting rates, we started to. No, I don't have a chart. I'm sorry. I just was thinking about whether I have it somewhere. But what you will see if you overlay, going back the last 20 years, let's say, so there were some rate hike cycles which ended. And what happened then after the Fed started cutting rates, you will see that gold prices doubled, more than doubled in all occasions. I think on average, I think we made something like 150, 180% or something like that. That was over the course of several years, certainly. So it wasn't that it would happen overnight. But that means, given that we are probably at the end now and get to see rather sooner or later rate cuts, that's extremely bullish for gold and makes it likely, the course, let's say, over the next 3-5 years, probably, that we'll push up to 3,000 USD per ounce, probably even higher than that, because 3,000 is only 50%. So doubling 150%, well, it's 4,000, 5,000 USD per ounce. That sounds fantastic right now. And some might probably shake their heads in disbelief, but given the current developments, especially also the developments around, let's say, the debt ceiling in the US, that's also a topic which is of importance here, and it's no question that they will extend this, but this is also something which, in addition to a more dovish stance from the Fed, which will follow, is longer term massively bullish for the for gold, but massively bearish for the US dollar. Even more interesting now, when looking at EURGBP, for example, that since Wednesday, what we've seen is that the US dollar gained. So especially towards the euro. So that was from last week. And let's go back here. When did we top out? That was this spike higher. So you can see it here. That was the third. Was it the second? Was it the third? It's kind of interesting. I'm sorry. I think was it the third or was it the second? I'm not sure. The fourth here? Was it here? I don't know. Well, whatever. So at least you saw some short-term USD bearishness, but from there, topping out around 111. Let's break it down here on a daily chart. We start to curl over and break this overall structure we established over the course of the last, I think, since the banking crisis. And market participants obviously betting on a more dovish stance from the Fed. And now, once this becomes clear, we start to roll over. And this is even more interesting when we look at what we got from the ECB last week. I have here the Reuters article, and you can see it in the headline already. So ECB slows rate hike pace, but signals more to come. So this is like 180-degree different story than what we get to see from the Fed. So we continue hiking rates, and we'll continue hiking further beyond that. So it was, as you can see here, that was the 7th straight hike so far, but it was the smallest move so far. But they are not yet done. You can see that the main deposit rate now is at 3.25%, which is significantly below the inflation in the Eurozone. Let's head over here to the Euro area. And here you can see inflation came in at 7%. That was on the 2nd of May, so around 2 weeks ago. And so we are significantly below that. Completely different story than when we look at the US, for example. And so tensions are potentially building in the banking sector too. Same story. It's not just the banking sector, but in addition to that, we also see massive trouble brewing in terms of the overall debt situation in the southern periphery, like Italy, for example. So you continue hiking rates and put a lot of pressure on these indebted countries like Italy, like Spain, especially Italy, at least, and the developments there, we can already see them. So it's not that we can say, well, is it really a problem? Obviously it is, because look at how they vote. I mean, the political landscape or the political situation, at least as long as I'm alive, has never been stable when looking at Italy. But with the current behavior of voters there and continuously voting for Euro, let's say, critical parties, more right-wing parties or more conservative parties. I have real trouble with right-wing in the wording here, especially over here in Germany. It's kind of like ridiculous. We're coming to a very ridiculous point. If you wanna shut someone down who has a different opinion or is skeptical about what's currently happening, you just label him right or whatever, and then story is over. But again, very conservative, Euro-critical. So this is something which is already speaking a clear language, that the tensions are brewing over there in the southern periphery, and the overall situation in Euro is very tense, and the Eurozone is very tense. And given that, banking sector, political landscape, also something you get to see here, well, somehow difficult to see further rate hikes. And if they continue, they are risking an escalation of the political situation, but also they, in this case, the ECB, but also from the banking sector and the debt scenery also, I think. And given all that, I think it somehow is already showing where the euro is headed in this environment, even if it's a more restrictive monetary policy path we get to see here from the ECB, which is then bringing the yield differential between the US and euro back together, which is usually something which should favor, in this case, the euro over the US dollar. But given this very tense situation, and in addition to that, also the situation in Germany, and let's face it, so the euro, the backbone of the euro is the German economy. And the German economy right now is, it's crippled. That's probably a good way to put it. It's crippled by policymakers over here. It's crippled especially by the Green Party. as far as I've heard it, everyone is laughing about the Germans and their energy policy, but also in addition to that, some politicians standing somewhere in front of a camera in other countries, foreign minister, for example, and giving their statements, and people are just shaking their disbeliefs and asking the simple question: and who's that? Who does she think she is, for example? And putting all this together, well, it's also underlying that here there's market participants right now anticipating that there's more pressure, or let's say a heavier economic downturn in the euro, or especially in Germany, to come, which is usually weighing on the euro and putting more pressure on the euro, which makes it likelier that in the course of the next, let's say months, let's see whether and how we behave around here, this blue line, which is the 200 SMA in this case. I think we have a chance to drop back to 105 and then see taking it from there. So if we drop to 105, then probably parity and further losses are likely. On the other side, if the Fed is very aggressive in their rate cut cycle, even though they are not right yet mentioning it, but chances are certainly given that we will get to see such a path, then it could weigh on the US dollar. And in this case, probably stop a sharper downturn here, but it looks more and more toppish in the euro. Putting all this together, I want to be honest, I don't want to be long the euro right now, especially against the US dollar, but I don't want to be long the US dollar too, to be honest, given that we are about to see a rate cut cycle, most likely. So putting all this together, let me come to the conclusion that I say, well, I want to be long gold right now. I want to be long because I'm more and more convinced that we are about to see a push above new all-time highs. And longer term, I think gold has lots of room on the upside. And given what I just said, in terms of this, in terms of what we could see over the course of the last 20 years, when when rate cuts are coming, or when the Fed is done hiking rates, and that we more than doubled in price in the gold price in USD terms, but also in euro terms, in this case probably even more aggressively. Well, then I'd put it that way. I'd say, well, I wanna be long gold in such an environment. Question from my end to you: are there any questions? So is there something I should keep an eye on, or what is of interest for you? What do you want to want me to look at here based on this overall situation? Probably what's interesting, and I just found out, for example, NASDAQ is very interesting for some, at least. I think that's a relative sign of strength, something which is not very surprising, to be honest, given what we've seen over the course, especially here, over the course of, let's say, the last probably 1.5 to 2 months. So there was certainly relative strength to be seen. And compared to the S&P 500, we've already broke 2 new yearly highs in the NASDAQ, and we have further room to go on the upside now, with room up to 13,700. Reason for that is very simple. It's also something I think we get to see here. Market participants are betting on a more dovish stance from the Fed here, because lower rates mean that yield-sensitive asset classes, in this case tech stocks, have potential on the upside. Solid earnings, that's something we've seen from the big tech side. Apple, Amazon, I think was very solid. As Apple was very solid, minimum. So Amazon, I'm not really sure about that. Google just broke out significantly, by the way. Let me just see, do I have it already open? I think so. GOO. Let me just see. So let me just was over here. So massive breakout. So this is a 4 hour. We can also go to the daily. You probably have seen that. Taking this out here. As you can see, massive breakout. So potential cup handle over here, breakout higher. Projected target around 88. What do we have here? 88. So around 20. Probably another $10 to go on the upside. So 125 These are the August highs, probably a little higher than that, 128. Strong zone of resistance over here, but holding above the 200 SMA. So tech stocks in general are very strong in the current environment. So if you want to be long in this environment, stocks, if you bet on squeeze higher, then potentially tech seems very interesting, even though we've run a bit already, and we have to see whether we take out the August highs here. But the same could also be true here, rather sooner or later for the S&P. So breaking to new yearly highs and potentially out of nothing. Out of nothing means there's no macro event directly connected to this. So FED didn't trigger the squeeze higher, inflation didn't squeeze or result in a squeeze higher. Probably it comes out of nothing, probably today. Let's just see. So right now it doesn't look that promising. So we are very choppy here. This is a 5-minute chart, very choppy into the open right now. Let's see if we can hold yesterday's close. This is, let me just check. Where do we was here? Somewhere here. So 130 around, potentially a flush lower. Let's see. And then ripping higher, new intraday highs, breaking above 4140, 4150. And then we are ready to go on the upside. But probably we also need some time. Let's just see. The DAX. Oh, yeah. Sure. Very similar to the S&P. I'm disappointed. I'm disappointed because I think we had already every chance to break above 16,000 already, haven't yet done so. Instead, yesterday especially, after an attempt to break higher, which I expected to be successful, in fact, we dropped sharply. On the other hand, never really attacked 15,700, and now coming in quite solid for the day. Let's see. So if you put a, hopefully not, but if you put a gun to my head and said, hey Jens, what do you think of DAX? I'd say breaking higher, probably with a break here to new intraday highs, breaking this short-term trend line higher as an anticipation of a squeeze above 16,000. But if we break, finally, if a break happens and is successful, I think a next projected target is realistically around the all-time highs, 16,300, probably even higher than that. And that's something, if you ask me how I come to the conclusion that we're probably even headed higher, this is a German website. But what we have here is the open interest profile, similar to what the CME offers, but only for the DAX. And as you can see here, so 15,900, the level we are currently tagged to, has a quite elevated short interest in terms of the short calls, but also in red, the short puts. So it's like a straddle to some extent, if you want. And if we're now breaking higher, then the market participants here, or if we start to push higher, then the market participants here in blue are forced to cover their shorts, and this could trigger some squeeze higher. And then you can see only at 16,000 there's another elevated blue bar, and then there's nothing happening till 16,700. So this is like how I see or find potential zones of resistance on the upside. Then if we push to levels we have never traded before or at before, in this case, here in terms of all-time highs, I have no other chance than looking at such a chart. Short, by the way, this is the bullish outlook. If we break lower, then breaking below 15,000 ends the party on the upside, at least short term. So I'm not very positive below 15,700 anymore. And if this trend line is broken, then we could also see a sellout, which brings us back around 14,500, 14,600 on the downside. But right now, I see chances higher with a break higher above the DAX and 2 new all-time highs in this case. So great. Thanks for the question. I hope you enjoyed the webinar. I hope you have a better overview now on what happened and how to trade the ECB, respectively FED rate decisions from last week, what to make out of this information. And from my end, have a nice weekend. Enjoy yourself. Talk to you again next week. I really look forward to it. All the best. See you.